All right, let's get started. We've got a spreadsheet in front of us, and what we're going to do today is we're going to take a look at the financial documents that we've already been looking at, the balance sheet and the profit and loss statement. And the purpose of this video is to demonstrate to you how these documents integrate with each other and how they integrate with the entirety of a full accounting system. Our goal is not to train you to be an accountant. Our goal is not to show you exactly how these documents go together. Our goal is to show you how these documents are tied together, how they're kind of interlaced and interwoven with each other. And we're just doing a very small sample of all of these interconnected documents. This is by no means a full-scale picture of all of the financial documents that are possible out there. So let's take a little overview of this spreadsheet. Let's zoom out and take a look at the documents that we have. The first thing that we have is a balance sheet dated December 31st, 1989, followed by a balance sheet dated December 31st, 1990. This is what we refer to as a beginning and an ending balance sheet. We might see these two kind of side by side, where the numbers are side by side. We might see them as two separate documents. There are a lot of ways to set up a beginning and ending balance sheet. We've also got a profit and loss statement for the business, and it's for the year ending December 31st, 1990. And we've got two other documents that we might see as a part of our financial documents. There are many others to include. I'm just including these two just to demonstrate them to you. And that is a statement of owner's equity and a statement of cash flows. So again, this is just kind of a tip of the iceberg for what all is out there. All right, let's jump right into our beginning balance sheet. I'm going to zoom in on the spreadsheet. I'm just hitting the control button on the keyboard and scrolling my mouse so that I can zoom in tight, make everything nice and big. And then I'll probably go ahead and do a little zoom with the software if I can pull that off here. So the first thing we're going to do is we're going to go to our assets, and we're going to look at our current assets, which in this case are just cash and inventory. So the idea here is that someone sat down at the beginning of their business, maybe this is the first time they've opened the business, and they just kind of wrote down how much cash they had, how much inventory they had, built some financial documents, pulled some stuff from other documents inside of their accounting system, and we've got to start building the spreadsheet. And what I've done with this particular example is everything that we need to calculate I've got in gray. So it's either something we have to calculate or we pull it from somewhere else that's in this sample of sheets that we have. So we type an equal sign and we type the word sum, then an open parenthesis, and we're going to highlight. We're going to click on the $200 cash number in cell B7, hold the mouse, drag down to highlight the $200 inventory number in B8. We're going to close the parentheses, we're going to hit enter, and we total up our current assets of $400. Same thing for our non-current assets. It's just equipment, but we're going to use the sum function anyway, because if we expand our spreadsheet later, the sum function will automatically expand with that spreadsheet. So the exact same process. Now we need to total up our total assets. We're going to use the auto sum. It's in the upper right-hand corner. We just click on the auto sum, and Excel is going to try to guess what I want to add up. It almost always guesses wrong. So we're going to zoom in tight here so you can see what's going on. I'm going to move my cursor to the upper right-hand corner of the cell. This is cell C12 until I get this diagonal arrow here. Two arrows pointing away from each other diagonally. I'm going to click. I'm going to hold. I'm going to highlight all the way up as far as I want to total. I'm going to release. I'm going to hit enter, and I've got a total assets of $800. Going to do the exact same thing with my current liabilities. We have revolving credit, like this person's got a credit card. So it's just a real small business and they're running a credit card, using a credit card to run the business. Equals sum F7, close the parentheses, hit enter, we're off and running. We also need to total up the liability and the equity. The equity came from some other document, right? It's some other thing that we used, okay? We have another document with the equity on it. Go to total liabilities plus equity, hit the auto sum button, drag up just like we did a minute ago because Excel guessed wrong. Hit enter, and hey, we've got an $800 total liabilities and equity, and we see that our balance sheet balances $800 and $800. Now let's roll over to the profit and loss statement and let's start working on it. We have sales of $1,200. Now another word for this might be revenue or receipts or gross receipts. No matter what, this document always starts off with a section that's either going to break down and then total up the different sources of money coming into the business, the revenue sources. And it goes by a lot of different names. But the format's always the same. We always start by listing the good news, and that's the money coming into the business. The next item we need to calculate is the beginning inventory. So this is the items we had in inventory, the dollar value of those items when we started at the beginning of 1990. So I'm going to click on cell J8, type an equal sign, and I'm going to scroll over to the balance sheet where I have an inventory here. This is the inventory on December 31st, 1989. Which means it's also the inventory the following morning when the year started. So I click on the $200 inventory number, and that gives me a cell reference, and I hit enter, and I am off and running with my beginning inventory. The next item is purchases. Now, this is an item that's going to come from somewhere in your financial statements. It's not just a number you write down. This is the money you spent on inventory items during 1990. So you added things to your inventory. This is what you spent on them. And now we're going to total up the beginning inventory and the purchases. Equals sum, open parentheses, click on the 200, drag down, release, close the parentheses, and we're done. And that is what we call the goods available for sale. So that's going to tell us the dollar value available for us to turn around and sell. The next item is ending inventory, and what you do is you go have an inventory sheet off to the side. So you would go look up your inventory at the end, and we have an ending inventory of $125. Now we need to find the cost of goods sold. That's just going to be equal to the goods available for sale in cell J11 minus the ending inventory in cell, let's see here, that's not working well. There we go. It's going to be equal to the goods available for sale, $850 in cell J10 minus the $125 ending inventory. So minus J10 minus J11 is the cost of goods sold. And so we sold $725 worth of stuff, or rather we spent $725 on the things that we sold. Now we're going to calculate the gross margin. The gross margin is going to be the sales of $1,200. So we'll type an equal sign, click on the $1,200 number for sales, minus our cost of goods sold. So click on the $725 cost of goods sold number and press enter. And that gives us our gross margin. You might see this go by a different name. You might see it called net or margin or something like that. In any case, we have this calculation where we figure out the revenue we brought in and we back out the cost of the stuff that we sold, and that gives us this margin number. Next, we total up our expenses. So we're going to type an equal sign in cell K20, type the word sum, open the parentheses, and then highlight the three items here that are expenses. And we're going to close that parenthesis and hit enter, and we have operating expenses of $340. Income before taxes. This is your actual profit in the business before you pay any taxes. So we type an equal sign, we click on the $475 gross margin, and we subtract the $340 operating expenses. And you can see it's color coded, the blue cell minus the red cell. Hit enter, we get a number, $135. Income taxes. Now, in this particular case, income taxes are going to be zero because if you only make $135, you don't actually pay any income taxes. Now, if this was $135,000, we need to do an income tax calculation here. But for today's purposes, we're just going to punch in a zero right there and not have any income taxes. Now we calculate the net income. This is our profit after taxes, how much money we have left in the business, or how much money we actually made after we paid our income taxes. Type an equal sign, click on income before taxes, click on the minus symbol, click on the dollar amount representing our income taxes, and hit enter. Now you might say to me, why go through all those steps? Why take 135 and subtract 0 from it? Here's why. Because next year when you're running this business and you're just basically going to copy and paste this stuff into the same spreadsheet, if you already enter the formula correctly in the net income cell and you have to pay income tax next year, then you just punch in the number for your income tax off of your income tax documents, and you're off and running, and you've got your net income automatically calculated. You don't have to go back and rebuild the formulas in your spreadsheet. Let's press enter and let's move on. Okay, good. We're going to take a look at this thing called a statement of owner's equity. Like the profit and loss statement, it is for the entire year of December 31st, the entire year that ended in December 31st of 1990. We have a beginning equity number. We can find that number on the balance sheet. So we type an equal sign in cell, I think it's 06. Scroll all the way over to our original balance sheet, find our equity number, which was $400, and we click on that $400 equity number. And that's going to give us a cell reference. You can see it up here. There's a cell reference. We hit enter, and now we're rocking and rolling. All right, net income. Net income is our profit. We mean net income, after taxes. So we type an equal sign, go over to our profit and loss statement, scroll down to the net income at the bottom, and click on that, and we've got our cell reference again. Hit enter, and we update. Now we calculate the ending equity, but before we do that, we have this item here called withdrawals. So that's an old term that represents the money that you pulled out of the business for your own personal use, which is kind of why you run a business, right? This is where you paid yourself. So we're going to type an equal sign, and we're going to type sum, open parentheses, and then we're going to highlight the beginning equity and the net income. And we're going to close that parenthesis, and then we're going to subtract our withdrawals of 300 by clicking on cell 08. And we hit enter, and we see our ending equity is $235. Now we're going to work on our statement of cash flows. It starts off with the beginning cash. We'll type an equal sign, and we'll roll all the way over here to our beginning balance sheet where we will find our beginning cash of $200. We click on that. It gives us a cell reference. We hit enter, and we're ready to go. Cash received from operations. Now this one right here might take a little bit of explaining. There are multiple ways that we might want to interpret this, and I'm not an accountant, and so if you want to talk about it in the comments and have a lively debate on the proper way to calculate this, feel free to do that. But this is the money that we brought in running our business, and the most straightforward way to do it is to just call it the gross margin. We could call it the sales, but then we'd have to back out purchases. So maybe not the best way to do this. Like I said, again, I'm not an accountant. I'm not 100% certain what goes here. But the point is that something goes here and you have to calculate it from somewhere else inside your accounting system on some other financial statement. Just to make things simple for us, we're going to use the gross margin. If you think about it, that is the cash you received from operations. That's the money that you got from selling your stuff. All right, cash operation expenses. That's going to be our total operating expenses. So we're going to type an equal sign and then find the operating expenses on the income statement or the profit and loss, whatever you want to call it, and we hit enter. All right, repayment of debt. There'll be some other document that will actually list that. So it's not something that you're just going to make up. You have it somewhere. Owner withdrawals, we figured that before. We'll type an equal sign. Go up here and find the withdrawals and click on it, and we're all set. Income taxes, type an equal sign. Our income taxes were 0, but we're still going to put them in here so that we can do the math. And we're off and running. Now we calculate the ending cash. We do an equal sign, and we type sum, and we highlight all the things that are cash kind of coming in, such as the cash we started with and the cash we received from our operations. We close the parenthesis, and then we subtract the sum of our cash operating expenses, our repayment of debt, our withdrawals, and our income taxes. We close that parenthesis, we hit enter, and we see that we have a big negative number there. Well, that's probably bad news. So one of two things has happened. Either we're mismanaging the business and in the process of running the business into the ground, or we've got a mistake somewhere in our accounting process. We really don't know which one it is, and we won't know until we've finished our accounting process. So what I'm going to do is I'm going to take a look at the rest of my accounting process and see what I get, and then I'm going to come back and see if things balance when I'm done, then I've done this right. If they don't balance when I'm done, then I've done this wrong. So what I'm going to do now is I'm going to go ahead and wrap the video up. I try to keep these videos as short as I possibly can, and I've been ranting on for about 15 minutes. So we're going to put a hard stop in it right here, and we're